Most traders don't lose because the market is against them. They lose because their stop loss is. In Wyckoff's world, a poorly placed stop is like handing your shares directly to the composite operator. Imagine buying a breakout, placing your stop just under the obvious swing low, right where every novice hides their escape door. Price dips, volume surges, and your stop gets triggered with surgical precision, only for the market to reverse and rally without you. That wasn't bad luck, that was poor position management. Wyckoff taught that stops must sit where the market proves you wrong, not where it conveniently fits your comfort. When your stop aligns with logic, not fear, you stop being hunted and start trading with the professionals. Ladies and gentlemen, traders and students of the market, today we confront one of the most neglected yet decisive factors separating consistent winners from perpetual victims, the art and science of placing stop losses correctly. Richard Wyckoff taught that losses are not merely numbers on a chart. They are signals, messages, and insights into market behavior. Yet most traders treat stop losses like emotional safety blankets, not strategic tools. They place them where it feels safe, instead of where the market proves their idea invalid. And as a result, they donate their positions to the composite operator long before the real move begins. Today, we uncover the truth behind stop-loss rules, why most traders set them exactly where professionals expect them to, and how you can align your risk with the market's logic, not its traps. In the world of professional trading, strategic stop placement is not merely a rule, it is a philosophy of survival. Richard Wyckoff emphasized that traders must learn to position themselves where the market reveals truth, not where fear whispers convenience. A stop loss, when used correctly, becomes your final line of defense, an intelligent guardian of your capital, not a trapdoor that the market effortlessly triggers. The average trader thinks of a stop purely as a number. I'll risk 20 points, or I'll place it below the last candle. But these decisions are detached from the deeper structure of market behavior. Strategic stop placement means your stop is anchored to logic, context, and the underlying intention of the composite operator, not the randomness of a price level. To place stops strategically, one must first understand that smart money knows exactly where amateurs hide. They know the predictable locations just below support, just above resistance, right under the swing low, right over the breakout high. These zones are not hidden, they are magnets. They attract liquidity. So when the market dips into these areas, it is often not a breakdown, but a deliberate sweep of stops to fill institutional orders. Wyckoff called this testing, a maneuver where price momentarily penetrates a level to evaluate supply or demand. Traders who place stops emotionally, without structural reasoning, find themselves triggered out right before the move they anticipated actually begins. A strategic stop, however, sits in a place where, if hit, it signals a genuine change in market character. It is the point where your trade idea is no longer valid, not where you simply feel like cutting risk. For instance, if you enter a long trade during an accumulation phase, your stop should not sit beneath every minor reaction. It should sit beneath the spring or beneath the decisive support level, where demand must appear if your analysis is correct. If the market violates that level with conviction, it is not hunting you. It is proving your hypothesis wrong. That is a rational exit, not an emotional one. Strategic stop placement also requires an understanding of volatility. A stop placed too tight suffocates the trade. Markets breathe. They fluctuate naturally. Wyckoff observed that the composite operator often shakes out impatient participants through seemingly erratic movements. Therefore, a trader must give the market enough space to move while still protecting their capital. This balance is achieved through studying average range, swing structure, and the personality of the asset being traded. A volatile pair requires deeper stops, a slow-moving asset demands tighter precision. Another critical element is position sizing. The size of your position must be determined after you know where your structural stop belongs, not the other way around. Most traders make the catastrophic mistake of choosing a position first, then squeezing a stop into the nearest safe-looking area. Professionals do the opposite. They locate the correct stop based on market structure, then size their trade so that the risk matches their account tolerance. Ultimately, strategic stop placement is the art of aligning your risk with the deeper truth of the market. A well-placed stop protects you from devastation, a poorly placed one robs you of opportunity. Trading is not about avoiding losses, it is about ensuring that every loss is meaningful, manageable, and aligned with the invisible logic that governs market movement. In Wyckoff's methodology, market structure validation is the backbone of every intelligent trading decision, especially when it comes to placing stop losses correctly. To Wyckoff, the market was not a chaotic battlefield, but a carefully orchestrated campaign conducted by the Composite Operator. A dominant force guiding price through phases of accumulation, markup, distribution, and markdown. Understanding where the market is in this cycle determines how a trader should participate and where they must defend themselves. A stop loss becomes meaningful only when it is anchored to validated structural behavior, not arbitrary lines or emotional bias. Market structure validation begins with recognizing the phase the market is operating in. Is it in accumulation, showing signs of compression, testing supply, preparing for a breakout? Or is it in distribution, where rallies are weak and supply absorbs every attempt to push higher? Without clarity on the phase, stop placement becomes guesswork. A trader who misreads the structure will place stops near noise rather than at levels where the market is truly invalidating their buyers. Wyckoff emphasized that structure reveals intent. Traders must align stops with that intent. Consider the classic accumulation pattern. Price moves through selling climax, automatic rally, secondary tests, and ultimately a spring or shakeout. The novice sees these as random spikes. The professional sees them as validation points. If a trader enters after a successful spring, their stop belongs beneath that spring. Why? Because the spring is not just a low, it is a structural message. It represents the final wash of supply, the deliberate clearing of weak hands. If the market revisits and breaks below that zone, the intended bullish campaign has likely failed. That's a legitimate invalidation. Not a shakeout, not a test, but a shift in character. This is what it means to validate a structure before trusting it. Additionally, market structure validation requires confirming the strength of support and resistance zones through price and volume. Wyckoff taught that support is not truly support unless demand shows itself when price reaches that level. Likewise, resistance is not resistance unless supply appears with force. When validation occurs through volume expansion, wicks tests, or inability to penetrate a level, traders gain clarity on where the line in the sand truly lies. Stops placed beyond these validated zones are protected by logic. Stops placed inside them are exposed to manipulation. Most traders skip validation entirely. They assume a support level is meaningful because it appears visually appealing or aligns with an indicator. Professionals wait for confirmation, a test of supply, a rejection, a low volume retest, or a failure to continue in the prior direction. This process ensures that the structure they are basing their risk on is real, not theoretical. Furthermore, market structure validation extends to identifying change of character, CH moments. These shifts signal that the market's behavior is diverging from expectations. If your stop is placed just beyond a structural validation point and the market violates it, that violation is valuable information. It tells you the cycle phase may be changing. Your exit becomes an intelligent retreat, not a premature abandonment. In essence, market structure validation transforms stop-loss placement from guesswork into strategic precision. It grounds your decisions in the market's true narrative, not illusions. When your stops reflect the underlying structure, not the noise, your trading transforms from reactive to professional, from fragile to resilient. When Richard Wyckoff spoke of the Composite Operator's CO'd, he wasn't describing a mythical villain. He was revealing the organized logic behind market movement. The Composite Operator represents the combined actions of large, informed interests who accumulate, manipulate, and distribute positions with strategic precision. To the untrained eye, their movements appear as randomness or volatility. But to the trained trader, they are intentional traps designed to exploit predictable human behavior. Understanding these traps is essential to placing stop losses intelligently, because the CO does not simply move the market, he hunts liquidity, and nothing feeds him more consistently than poorly placed stops. Composite operator traps exist because retail traders cluster their stops in the most obvious locations. Wyckoff mapped these regions meticulously, beneath swing lows, above swing highs, just below support, right above resistance, beneath pullbacks, or right above breakout levels. These are the areas where the herd seeks safety. Unfortunately, these are also the areas where the CO finds his biggest opportunity. Why? Because stops represent liquidity pools, a source of immediate buy or sell orders that allow large interests to execute massive positions without shocking the market. Consider a simple example: price consolidates, shows a support level, and novices place their stops directly underneath it. The composite operator, wanting to accumulate more shares, deliberately pushes price below support to trigger those clustered stops. The moment retail traders panic and exit, their market sells provide the liquidity the CO needs to buy large quantities. This maneuver, known as a spring, looks to the untrained trader like a breakdown, but in Wyckoff terms it is a crafted trap, a final shakeout before the true move begins. The same mechanism works during distribution. Prices appear to be breaking above resistance, triggering breakout traders and sucker entries. But the composite operator uses this false enthusiasm to unload his holdings into the excited crowd. Once his distribution is complete, price collapses, leaving breakout buyers trapped at the top. This is the infamous upthrust after distribution, Annotated, a classic trap Wyckoff highlighted as the graveyard of emotionally driven trading. Composite operator traps also target traders who misunderstand volatility. Most beginners place stops too tight, believing they are protecting capital, when in reality they are handing their positions directly to the CO. A tight stop near noise ensures you get shaken out during normal fluctuations. The CO doesn't need to deliberately manipulate the market. Your stop is simply positioned where the market naturally breathes. Understanding how these traps work turns the game in your favor. When you recognize the CO's intentions, whether he is absorbing supply, conducting a shakeout test, or creating a false breakout, you begin placing stops where only a genuine structural failure would hit them. You stop clustering your exits where everyone else hides, and instead you anchor them behind meaningful levels, springs, upthrusts, last points of support LPS, last points of supplies LPSY, or confirmed structural pivots. Ultimately, the composite operator's traps are not designed to ruin traders. They are designed to facilitate his campaigns, but those who fail to understand them become the fuel for those campaigns. When you study Wyckoff's principles and position your stops outside the CO's hunting grounds, you no longer serve as prey. You begin to walk with the professionals, not against them. One of the most transformative principles in professional trading, yet one of the least practiced by retail traders, is risk to logic alignment. In Wyckoff's philosophy, every decision must be rooted in market logic, not in emotional comfort or arbitrary formulas. To align risk with logic means that your stop, loss, your position size, and even your entry must reflect the structure of the market, not the structure of your fears. Most traders define risk as, how much am I willing to lose? Professionals define risk as, Where does the market prove my idea wrong? This is the difference between placing a stop-loss as a defensive reflex and positioning it as a strategic tool aligned with market truth. Risk to logic alignment begins with understanding that the market does not care about your account size, your hopes, or your preferred levels. The market cares only about supply and demand behavior, phases, tests, and shifts in character. Therefore, a stop-loss placed based on a round number, a tight percentage, or a random distance from your entry is catastrophically flawed. Wyckoff insisted that the market must invalidate your hypothesis, not simply touch your fear threshold, before you accept a loss. When your stop is tied to a validated structural point, such as a spring, upthrust, LPS, LPSY, or major support resistance, you exit with integrity, not panic. The greatest barrier to aligning risk with logic is the human desire for a comfortable stop. Traders want stops that feel close enough to minimize loss, but far enough to stay in the trade. But this does not reflect the reality of market behavior. The market's natural volatility often exceeds the comfort levels of most beginners. A stop placed based on comfort rather than logic becomes a magnet for whipsaws, shakeouts, and liquidity hunts. Wyckoff understood that price must retest levels, absorb supply, and investigate demand before a true move can begin. Tight stops ignore this reality. Logical stops embrace it. Position sizing is another critical component of risk to logic alignment. Retail traders typically size their positions first, then force a stop into the nearest safe-looking location to fit their risk appetite. Professionals do the opposite. 1. Define the logical stop using market structure. 2. Calculate position size so the total risk remains acceptable. This shift in workflow is what separates deliberate trading from impulsive gambling. A logical stop may sit 30 points away, 60 points away, or 5 points away. It depends entirely on the structure, not arbitrary rules. Your job is not to move the stop into comfort. Your job is to scale your position to match the logical stop. Risk to logic alignment also protects traders from composite operator traps. When your stop is positioned only where the structure truly changes, the CO must make a genuine campaign, level shift to hit your stop, not merely a quick shakeout. This dramatically reduces getting stopped out prematurely and increases the probability that your losses occur only when your analysis was legitimately incorrect. Ultimately, risk to logic alignment is the marriage of technical understanding and emotional maturity. It demands that you abandon hope-based trading and operate like a strategist. Losses become informative rather than painful. You stop fearing them because each one represents a moment where the market genuinely invalidated your view, not where you simply panicked. In Wyckoff terms, you begin trading the market as it is, not as you wish it to be. Emotional discipline in exits is, without exaggeration, the defining mark of a mature trader. Wyckoff often emphasized that markets expose a trader's character more than they test their technical knowledge. Nowhere is this more evident than in the moment a trader decides to exit a trade, especially when that exit is a stop-loss. While most traders attempt to master chart patterns, indicators, or entry timing, the true battle is internal. Emotional discipline in exits determines whether a trader protects capital intelligently or donates it repeatedly through fear-based decisions. Every trader enters the market with a vision of profit, but few prepare themselves for the emotional weight of admitting they were wrong. Wyckoff believed that losses were not failures. They were essential feedback mechanisms that guided the trader toward alignment with the composite operator's intentions. But instead of embracing this, many traders sabotage themselves through emotional reactions, tightening stops impulsively, moving stops to avoid getting hit, widening stops to escape pain, or abandoning stops entirely. These actions distort logic and expose the trader to catastrophic risk. Emotional discipline eliminates this behavior by transforming the stop-loss from an emotional threshold into a strategic, planned decision. A disciplined exit begins before the trade is even entered. The trader must identify the structural point where the market will prove their idea invalid. This is not a point chosen out of fear or convenience. It is chosen out of logic. Wyckoff taught that once this point is identified, the trader must make a covenant with themselves that level will not be adjusted emotionally. The moment the market hits it, the trader exits without hesitation, without negotiation, and without justification. The emotional mind may scream, "It's just a wick," or "maybe it will bounce." But the disciplined trader honors the plan. Emotional discipline in exits also means resisting the temptation to exit early out of fear. Many traders sabotage winning trades by cutting them too soon, driven by anxiety rather than evidence. Wyckoff understood that large operators often create temporary reactions, pullbacks, tests, or shallow dips, to gauge market interest. Undisciplined traders interpret these routine movements as threats and exit prematurely, missing the true move. Emotional discipline allows the trader to remain patient, confident in their structural understanding. They exit only when the market demonstrates genuine weakness, not when their nerves tighten. One of the most powerful forms of emotional discipline in exits is accepting that losses are not personal. A stop loss is not a judgment of your intelligence, it is the market's way of maintaining honesty. When you take a disciplined exit, you preserve capital, clarity, and psychological strength. When you refuse to exit, losses deepen, emotions explode, and future decisions become clouded by regret and fear. Wyckoff repeatedly emphasized that the composite operator feeds on emotional traders. They sell too late, buy too early, and exit at the worst possible moments. Emotional discipline reverses this pattern. When your exits are governed by logic rather than reactive impulses, you stop becoming a liquidity source for professionals and start behaving like one of them. Your losses become controlled, your wins become meaningful, and your trading career gains stability. Emotional discipline is not just a skill. It is the foundation of long-term survival. In the end, mastering stop-loss placement is not about finding the perfect number of points or following rigid rules. It is about learning to think like a professional. Wyckoff taught us that the market is a living campaign guided by intention, structure, and the deliberate actions of the composite operator. When you place your stop strategically, validate the underlying market structure, understand the traps designed to harvest liquidity, align your risk with logic, and maintain emotional discipline in every exit, you stop trading like prey and start trading like a student of truth. Losses become purposeful, entries become cleaner, and exits become confident. This is the evolution from being a reactive chart watcher to becoming a disciplined operator who respects market law. In trading, survival is not accidental. It is engineered. Your stop loss is not the end of the trade, it is the beginning of your professionalism.